All right, welcome everybody. Clearly the market continues to grind higher. Decent Netflix earnings today. Stock is trading slightly higher in the aftermarket, making the NASDAQ 100 futures pop a little bit after being up for the day. We did have a nice finish into the close on those futures. The thing I want to talk about today is a position management technique regarding earnings. There's a position in the educational portfolio in Schlumberger that we've been working on since we put the trade on right here. And you could see that we bought the November 67.5 calls for $3.47. However, again, because of the magic of option premium collection, the cost of this trade to us at this point is really 207. 207. So we've knocked out about 40% of the risk of that purchase. And we've been holding this trade since the end of July 31st. So we've obviously had it for a while, and we could have been a little more aggressive in a couple of ways. Number one, we could have been selling more premium. We could have been selling premium on a more regular basis. We've only actually done 4 premium collections since we started. And there were times during the life of this trade, especially in the recent history, where the stock did rally back up, and I think we could have gotten out of this trade for a profit. But that's water under the bridge at this point. What I want to show you is something that I tried to do today with this position. The trade did not go off, but I will be looking to do it tomorrow. Now, here's the point. The point here is that we have earnings coming out Friday morning before the opening. Okay, so let me show you that. Again, sorry for the delay. I don't know if it's my computer or the bandwidth. Here you go. Earnings October 20th before market open. Okay, that happens to be also the option expiration day. So the stock right now is 66.80. It's in a group that's been doing better, but it's been very, very volatile. So the driving force behind this technique that I'm about to show you is you expect the stock not to be near where it is now. In other words, earnings will either be lousy and the stock will go down, or the earnings will be good or better than expected, or not as bad as expected, let's say, and the stock will run up into the $70 area. Okay? The usual method of the diagonal spread, which is selling weekly premium, is not going to help us in this situation. Why will it not help us in this situation? The reason why it will not help us in this situation, and let me get to this. Let's get rid of this over here. Okay, we're going to do Schlumberger right here. Again, apologies for the delay. The reason why just selling premium as usual is probably not going to be the best way to go is that if we just sell a call against our position, okay, and there's a lot of adjustments here, so hang on one second. Let me filter this so we can get rid of some of these expirations. Days to expiration, there we go. Let's just get rid of a whole bunch of these. We really don't need these for what I'm going to show you. Okay, there you go. That gets rid of a ton of them. Okay, so granted, when you have earnings, you do have a heightened level of implied volatility. So if we just compare the level of implied volatility in the options we own, it's about 2022, and here the options are trading in the high 20s. So yes, there is an elevated level of premium, and if we did sell, let's say, the 67 calls for this week, yeah, we would bring in 67 cents, let's say 70 cents, and against our 204, that would get us down to $1.34. However, we got a problem, right? It's only 67 cents against the 67 call. If the earnings are great and the stock runs up to 70, 71, we're in a tough spot because now we'll have a deep in the money call, and what the heck are we going to do in terms of rolling that call? And we've seen that happen to us a couple of times with some of our more recent positions. You know, stocks that we wanted to take a bullish diagonal approach to, but the stock even ran up so fast that the short call, because of its high gamma, picked up delta very quickly, and it made it hard to do the rolls. That's why, if you notice, we've been picking up dimes and nickels and quarters here and there, nothing really big, because we've been needing to roll from strike to strike, not from strike to a higher strike with these call diagonals. So that's not really going to help us. However, there is an alternative. And what I was trying to do today was the following. The alternative approach is to sell a slightly in-the-money call spread and collect premium. Okay? That way, what happens is, if the stock declines, the call spread will expire worthless, and that will lower our cost even further. Not that we know for sure that the stock will recover, but on the upside, if the stock runs up, the short call spread has a maximum value of the difference between the strike prices, leaving our long call free to run up if the stock runs up. So let me show you against a cost of 207, and I got to write that down so you know you can follow the adjustment I'm going to make. Against the cost of 207, what this trade is going to look like when you add it to the existing position. Okay, so what I was trying to do today is I was trying to sell the 64 call for this week and buy the 66 call for this week for $1.70. Okay, now you can see it closed at $1.65. Okay, which is not too bad. So tomorrow, if we it looks like maybe we'll get a little more theta decay, and hopefully the stock won't go down, because actually in this trade, because you have negative delta, right? We want the stock to go up because we want the spread to go up in value so we could sell it for a higher amount. But suffice it to say, let's just say that this spread that we do, that we're looking to do, we were able to do it today for $1.65 credit. Okay, so $1.65 credit off of our current $2.07 cost brings us down to a net cost of only 42 cents. Okay, 42 cents. Okay, now in order to get the right simulation, we need this net to come out to 42 cents because the system does not know that we've collected all this other premium. All it knows is that we bought this 67.5 call for $3.40. So how do we get $3.40 down to a 42-cent credit? I mean, a 42-cent cost. We have to readjust. We have to adjust the trade. And we actually have to put this in at a 298 credit. Okay. Hopefully you follow that. Okay. What we're doing is we're adjusting the credit we're going to get for this trade to a high enough level, which is 298, so that the net between these two, the two things that are showing on the platform, come out to the same net that we will have in our tracking of our account, of our position, which is 42 cents. Okay, so I'm going to move this to $2.98. Hang on, let me get to the eraser. So I'm going to change this to $2.98 so that when we simulate this trade, it will look the same, exactly the same. It will look exactly the same. Hold on, let me see if I can delete this. Hang on. We got to get this to 298. Again, I apologize for the slow response. Okay, hang on one sec. Having a little trouble with the platform. Stay with me 1 second here. The program appears to be performing slowly. An error report. Send the report. Okay. All right, I think we got it now. Hang on 1 second. Okay, good. Okay, so we're going to change this to $2.98 so that the net effect is that the trade now is only 42 cents. And now we're going to simulate that trade. Okay. Again, I guess there you go. Okay, now what we're looking at is two lines, one of which is today, which is this pink line, and this is Friday's expiration day. Here's Friday. This is the day that earnings come out. Okay, so why is this better than just selling the calls? Well, it's got a couple of good things going for it, right? And this is making the assumption that with the stock right here at 66.80, okay, right here, okay, that when earnings come out, the stock will make a move one way or the other. If the stock has bad news and it goes down into the low 60s, obviously our cost is going to be down to, what did we say it was going to be? Only 42 cents. So we'll be able to hold on to that November 67.5 call and only have 42 cents worth of risk. Not bad. Okay. Actually, the best place for it to be is right there, which is at 64, because at that point, the spread is still worthless, but you could see the loss, and this is on a 5 lot, the loss is only $62 on this 5 lot that we've had, right? So this was one of the first trades we did. Since then, we've been using only 1 lot and letting the folks in the course, when they watch these, we've been letting you figure out how many of these is appropriate for you. But we've been using the same techniques. We've been managing these 1 lots just the way you would manage a 5 lot, a 10 lot, a 50 lot. You know, obviously the smaller numbers, 1 lots are really hard because you can incur the commission every time. Okay, but anyway, you could see at 64, if we really wanted to just ditch the whole thing, this 5 lot only has a $62 loss. So what's that? What's that? 12 cents? 13 cents? I mean, remember, we started this trade off with, you know, almost $3 worth of risk, and now we only have 12 cents. Okay, 13 cents. I think that's good position management, right? What we're trying to do is make 25, 30, 35% on a trade on our initial invested capital when we put on the trade, and keep the losses when they happen. We've only had 1 losing trade as of this date, using our techniques in the educational portfolio. Keep those losses, you know, 10, 15%, a lot of scratch trades, right? Okay, so obviously, if the earnings are bad and the stock craters, we're fine. If the stock has good news and the stock trades up to 71, let's just say, okay, let's say it goes up to 71, now we're looking at, you could see here where it says October 21st in the blue, there's a little box down there. It's a $700 profit on a 5 lot, which is what? What's 700 divided by 5? $140 per spread, which is fantastic, right? We're getting close to like a 50% return on that, right? So we could close it out, okay? So the reason that happens is that because it's only a $2 spread, once the stock is above 66, the spread is worth $2, and that's it. So whether the stock is 66, 67, 68, 69, 70, 71, 72, the spread can't be worth more than $2 against us. If we sell it for $1.65, that's really holding our profit back by 35 cents, right? Because we have to buy that spread back for $2. But it's not going to have that much of an impact because that November 67.5 call is just going to keep running. And you could see if on Friday the earnings are really good and the stock can get up to 73, which I doubt, that's a 10% move from here just about. We're talking about a huge profit. We're talking about $300 per spread. Okay, so where's the danger? Right? The danger is if the stock closes right at 66, obviously we have to buy the spread back for 2. We sold it for 165. We're going to add 35 cents to our overall risk, and then we'll have to start selling calls again, right? Anything less than that is actually helping us, right? Because we know the 67.5 call by itself is going to be going down, 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 down. So this is actually helping us. So we sell the spread for $1.65. If the stock gets down to 64.50, we can buy the spread back for 50 cents, and we'll capture $1.15 of that $1.35, right? So the lesson in this kind of environment, when you have a position like this, think about modeling some kind of short spread instead of just doing your regular premium collection or doing nothing. Sometimes people do nothing because they don't know which way to go. Right? Is the stock going to go up? Is it going to go down? Right? If I sell an in the money call and the stock goes down, that's great. I get to keep that premium. It lowers the risk. But if the stock goes up, it's like doing a covered call. Deep in the money covered call, the stock goes up, you're stuck with a short strike that's below the current stock price. If you don't do anything and the stock goes up, you're golden. But if the stock goes down, you haven't done anything to hedge the risk. Okay? So the point of this video today, and I'm not going to do a lot. I'll go through some of the trades that we have on in the next 10 or 15 minutes. But the main point that I want to get across to you today is that by expanding your knowledge of strategies and how options behave, what happens is you start playing around with things, and when you understand conceptually what's going on, like here, you can start doing some very creative things, right? This is just a conceptual exercise that I did in my brain. I said, well, wait a second. What? I know that I don't want to just sell a call against my long because of the reasons that I explained very clearly before. However, what if I sell a call spread? I'll still collect some net premium. I'll still collect premium because I'm selling a call spread. However, on the upside, because the call spread has a maximum value against me, if the stock shoots up, it will free up the long call at some point, right? Right over here, right above 66, it frees up the long call, except for the 35 cents that I have to pay back to buy the spread back. This call is going up unfettered. There's nothing blocking it. On the downside, if the stock collapses, I've sold an in the money call spread, which should have a value approaching the distance between the strike prices, the potential full value of the spread. So if the stock collapses and I have my risk down to whatever it was, 42 cents, I can live with that, right? That's the game that we're playing. We're trying to play a game here where we keep setting ourselves up to make decent profits if we're right, lower the percentage of losers, and when we get a loser, the loser's not that big. Now, every once in a while, like the AbbVie, because I don't think that AbbVie is going to work out, we're going to have one that doesn't work out so well. Okay? But if that happens once or twice a year, which it usually does, it's not going to have that big of an impact on our overall results because we're going to be ringing the cash register on a much more regular basis. And when we ring the cash register, we're going to be putting money into the cash register. There's going to be more money coming in than when we ring the cash register and we have to take money out. Sort of like when someone comes into our store and returns a piece of merchandise, right? We go into the cash register and we give the money back. Okay, so very, very important exercise here. Everybody should rewind this and watch this 2 or 3 times and go over it so that you really understand why this looks the way it does and why this is a valid strategy for this week, for this earnings week, okay? Because we have that long November call. Okay? All right, good. Okay, forget about that. Rest of the board. Accenture. Let's take a look. You know we like the stock. We have a $2 spread here, the 135, 137. That's how we started, right? We didn't, because the stock, again, this is one of the challenges of doing these call diagonals like this, is you do get a stock that runs up. In other words, we're too right, if you will, and the stock runs up. So right now we are long this spread with the stock at 139 for $1.90. And right now it's trading 220. It's trading at $2.13. Okay, so we only have about a 23-cent profit on this after we started on October 5th. So it's been about 10 days. It hasn't even been 2 weeks yet. And we really need the stock to back off a little bit. Again, I've said this before, kind of tongue in cheek. It's kind of funny. We have a bullish trade and we want the stock to go down because we would love the stock to be 137 or close to 137 on Friday. Okay, if not, we're going to have to play around with this and hopefully try to collect some little bit of premium or skip a week or turn it into a bull call spread just in using the November options, because eventually we should be able to collect some premium if we went from October 137 to, let's say, I don't even know if it's there. Let's take a look. November, there is no 137, so I have to go to the 140. Okay, that's even going to cost us a $1 debit. That's even going to cost us $1, but it would be a $5 spread, and our cost would be $2.90. I don't know if I'm that keen on that. Okay, so that's where we are on Accenture. Okay, on Carnival Cruise, we did this on October 10th when the stock was 67.36. We did our roll on Friday when the stock was 67.59. Now the stock is 68.24. So you see that's a problem. However, we are short the 68 call, so it's not the worst thing in the world. This option is only 24 cents in the money, and we collected 45 cents for it. The net cost of this trade to us right now in the educational portfolio is only $1.65. And the trade is now 210. So we've got a 45-cent profit. Our initial cost was 205. So we're in the 22% range right away with only being in this trade for 5 days or so. Okay, so that's looking pretty good. Again, we'd be really pleased if the stock just sat here or declined a little bit. Clearly 68.45 on the expiration day works for us, because then we buy back this option for what we sold it for, and we collect the net extrinsic value for the week following. I'll come back to Celgene in a second because that's a little complicated. If you remember last week's video. CRM, Salesforce, we started this on October 3rd for a $5 credit. $5 debit. Now we're down to $4.10, and we're long the 92.5, and we're short the 95.5. The trade right now is at 456. So again, we got about a 45-cent profit. That's only 9% on our initial invested capital. So again, victims of our own success, right? Good stock picking, but a little too good. Right? We really don't want the stock to go up this much, this fast. We really want it to kind of take its time. So hopefully, again, we'll get a chance to collect some more premium. Last week when we rolled from the 95.5 to the 95.5 with the stock 96.74, we collected 33 cents. We collected 57 cents the week before, and we collected 50 cents when we started the trade. Okay, so that's not too bad. Okay, Lowe's. Lowe's is something that we have been trying to rectify ourselves because we started off with a short 79.5 call and a long 80 call. Okay, it was kind of a reverse diagonal. We talk about that trade in the course. I think we used MasterCard as the example, and the point was I thought that the stock was looking much better technically, but I wanted to collect the extra premium by selling the short-term option at a strike lower than the option I was buying. So this November 80 call that we started with on September 12th was actually paired up against the September 22 expiration with a 79.5 call. And that was because I wanted to collect that 69 cents. So we had a starting cost of this trade at $1.44. Now the stock ran right up. So we were able to take out 25 cents, then 20 cents, then 13 cents, then another 13 cents. But we got stuck on September 29th, rolling from the 79.5 to the 80. And then we got stuck in the 80 call because the stock kept going up. So we were able to take out just a little bit of money each week, 13 cents and then another 13 cents. So here's our situation. We have a calendar spread and we have a net cost of 73 cents. The trade itself right now is about 86 cents. So it's no big deal. I mean, we only have a 13-cent profit, which is barely 10% on our initial cost. Okay. Obviously, it's a lot higher on our average cost, right? We started at $1.44. Now we're at 73. So our average cost of $2.17, we're talking about maybe what, $1.08 or so. So it's a little over 10, but let's just say about 10%. Now we got lucky today because the stock did back off by $1.13, giving us an opportunity to have this 80 call back off a little bit. So let's take a quick look and see, since I didn't look at it today, what the roll from the 80 to the 80 would actually have paid us if we did it today, if anything. Where is it? Oh, it's a 16-cent credit. Okay, that's not too bad. That would get us down to 57 cents. That's not too bad. What if we went up to the 80.5? Would that be probably a slight debit? Let's see. Let's move this to the 80.5 right here. Now, where are we? Yeah, it's a 17-cent debit. So I don't want to do that. I don't want to start adding cost to the trade. So again, victims of our own success. Okay, maybe we shouldn't be such good stock pickers. Last, before I get to the Celgene, is the Las Vegas Sands. Right, did this trade post the event. Did it on September 27th. Started out with a $2.76 cost. We're down to $2.16, and here's where we're at. We're long the 62.5. We're short the 63.5. We have a November option. Right now, unfortunately, we're only at $1.75, so we're at about a 40-cent loss, which is about a 15% loss on our initial invested capital of 276. And we're going to watch this one closely because today's high was 63.29 if you look over here. So we got to be a little watchful of that. We got to be prepared to roll this thing out because we did start with the 65 call on the short side. Okay, but this decline last week wasn't very pleasant, so took the risk of lowering the strike price down to 63.5 with the intent that we'd roll it back up and out if the stock started going back up. Okay, Celgene. Okay, I know if you've been following us, you know this is another trade that we've had on the books here since August 30th. We started with a net cost of $6.30. Last week, I showed you how I took this October 135 call that we're long, took last week's October 138 call that we were short, and converted the diagonal spread into a broken wing butterfly for this week. And this maneuver took out $1.97. It created a $1.97 credit. In other words, buying back the October 13 138 call and overlaying the ratio spread, this 2-to-1 spread, creating the broken wing butterfly, generated $1.97 credit, getting our cost, our risk on this trade now is only down to 2 cents. Okay, we started at $6.30. Now the risk is only 2 cents. And what do we have? We have a broken wing butterfly. We're long a $3 call spread. Let me show you. We're long a $3 call spread, and we're short a $2 call spread. If the stock closes above 140, the $3 call spread becomes money we get back. There's your $3. Sorry, that's a little mushy. And we pay back 2, so we end up with 1, which means we make 98 cents on this trade. I know it's been going on since, the end of August, but this happens sometimes, right? Ideally, we'd love to be in and out of these things in a couple of 3 weeks, take our 30, 35, 40% return on initial capital and go on to the next thing. But, I don't control the market. I only control what I do in response to the market. Okay, where's the stock right now? The stock right now is 137. The stock was as high as 138.20, which would have been perfect, because if the stock closes at 138, the short spread expires worthless. We get $3 back for the long spread, and now we have almost a $2 profit on our trade, which is more than 30% on the original invested capital of $6.30. It's amazing. Okay? And we only have 2 cents worth of risk if something bad happens and the stock collapses. So right now, what's going on here? Okay, the options we're short are worth 78 cents a piece. So if we buy those back, let's call that $1.60. Okay, $1.60. The options we're long are $2.56 and 26 cents. We add those together, and we get $2.84, which right now we're sitting with a net value of our trade of $1.24. Against our 2 cent current risk, we're actually up about $1.20, which is almost 20% on our initial cost of $6.30. So I could take this thing off right now and we'd have a 20% return on the initial investment of $6.30. It's a miracle, if you ask me. This is why we love options here. Because there is no, when I go out, and I apologize for no newsletter this week, because I was teaching Saturday and Sunday. When I go out on the road and I'm explaining these things to people, the faces light up like they can't believe that something like this is possible. They haven't seen anything like this before. They're used to trading stock. If they've traded options before, they've subscribed to some service where, as my friend Tom used to say when at one of my first jobs, you got a hunch, you bet a bunch. Right? Stock's going up, buy a bunch of calls. Stock's going down, buy a bunch of puts. No foresight or no insight into how you manage a trade on an ongoing basis. And time spreads happen to afford us the opportunity to manage the trades over time as the stock moves through time. So here we are with this broken wing butterfly. The stock runs up. We know we won't get back less than $1. If the stock closes at 138, we know we're going to get $3 back. Anywhere between 135 and 140, right, we're going to get something back. Right? I mean, 135 or higher, we're going to get something back. But it could be as much as 3. It could be as little as 0, right? 135, right? Let's say 135.01, right? It's got to be above. Actually, it's got to be above 135.02. Okay, so let's just call it 135. Right? And now, this week, we would love for this stock to just move up a little bit more to the $1.38 area. The stock was very oversold, right? It did break below the moving averages that we follow, the 20 and the 8. And let's see what happens. But I could pull the trigger. I could pull the trigger tomorrow and sell this thing for close to buck 20. We have a net delta of plus 14, and we have a net theta of plus 452. Okay, so we got $4.52 of positive theta tomorrow, and we've got a 14 delta. Okay, so even if the stock goes down $1 tomorrow, it should only lower the value of this by about 10 cents. So I think we're in good shape on this, right? And that's, again, we were a victim of our own success. The stock ran all the way up into the 140s. But as the stock started coming down and we were collecting a little bit more premium, boom, all of a sudden this thing shows up. We jump on it, okay? So last week I introduced this management technique. Today I showed you the Schlumberger using the short call spread. These are the kind of things that traders use to improve the chances of them making money. And it's the kind of things that, since you're in this course, you really have an opportunity to learn and experiment with and take advantage of. So I'll wish you all a very good evening, a successful couple of days, and I'll see you on Wednesday night. All right, so everybody take care, and I'll see you Wednesday.